Picture this. You've got a $70 billion corporate giant, a total household name, right? Millions of people rely on their services literally every single day. And if you just glance at the surface, their financials look absolutely flawless. We're talking metrics that would make any value investor's heart race. But when you actually lift the hood, you find this crazy maze of deep accounting mysteries and totally conflicting signals. So, welcome to today's Explainer, where we're putting America's largest publicly held personal lines insurer, Allstate, under the microscope. Is this the perfect value stock, or are we staring straight into a massive value trap?
To really understand why this company is generating so much buzz right now, we have to start with this ridiculously low number, 5.5. That is Allstate's current price-to-earnings ratio. Now, in an industry where the average PE usually hovers somewhere between 15 and 20 times earnings, a 5.5x multiple, that represents a massive 65 to 70% discount. It basically means the market is pricing this stock for extreme pessimism, which of course makes it look unbelievably cheap.
But hold on, it actually gets crazier. Look at this figure, 46.1%. That's their return on equity. To put that into perspective for you, Warren Buffett typically looks for an ROE of just 15% to signal a high-quality business, and the industry average usually sits somewhere between 10 and 15%. Allstate is sitting at a towering 46.1%. That makes it one of the highest in the entire S&P 500. We are talking elite-level profitability on a shareholder equity basis here. And here is the final hook, the metric that is pretty much the absolute holy grail of insurance profitability, 86.6%. This is their combined ratio for the second quarter of 2026. In the insurance world, anything below 100 is fantastic. So to hit 86.6, that means their core business of writing policies is an absolute cash machine.
Here's the catch, though. We don't have forever to debate this. There is some real immediate urgency here. The ex-dividend date is August 31st, 2026. That is just 23 days away. If you want to lock in their 1.6% yield, the clock is absolutely ticking. You really need to figure out right now if this stock is a trap before that deadline passes us by.
Okay, let's untangle these conflicting metrics. We're going to cover all points and make this as easy to understand as possible. So here's the roadmap. 1. The ultimate value mystery. 2. Allstate by the numbers. 3. The hidden red flags. 4. The compelling green flags. 5. The guru gauntlet. And finally 6. The final verdict. Buy or pass.
Let's dive into Section 1, the ultimate value mystery, unpacking America's largest insurer. So you know Allstate, right? From their iconic "You're in good hands" slogan. And they have this massive scale of 216 million active policies. But here's the central mystery we really need to solve today. The stock has been on an absolute tear. It's up 27.8% over the past year, trading right near its 52-week high of around $267. And it features a massive 17.7% owner earnings yield, which is frankly incredible. But when we start looking at critical value thresholds, these massive warning signs start flashing. The price-to-book ratio is pretty elevated at 2.28x, and the price-to-earnings growth, or PEG ratio, sits at a very high 3.15. So how can a stock be this cheap on earnings, yet look this expensive on growth and book value? It's like a giant puzzle.
Moving right along to Section 2, Allstate by the numbers. Let's translate that Q2 2026 blowout.
Just looking at the sheer financial momentum they've got right now, this quarter was a blowout. They beat adjusted EPS expectations by a whopping 56%, pulling in $8.99 per share, right alongside $1 billion in net investment income. And let's look at that combined ratio again. Think about it like this. At 86.6%, it means that for every single dollar Allstate takes in, they only spend 86.6 cents on claims and operational expenses. They are literally pocketing 13.4 cents of pure profit from underwriting alone, and that is before they even invest those premiums to make additional income.
All right, Section 3, the hidden red flags, what the mainstream press is completely missing.
To truly understand if this is a value trap, we have to look past those surface-level metrics. Now, what's really interesting about this slide is the stark contrast. On one hand, we have the PE of 5.5x, which looks insanely cheap. But on the other hand, the PEG ratio is 3.15. You might remember the legendary investor Peter Lynch had a golden rule. The PE should roughly equal the growth rate, meaning a PEG of exactly 1.0. So a ratio of 3.15 shows us that despite that super low PE, the stock is actually vastly overpriced relative to its expected growth rate. And then you have this massive accounting discrepancy regarding the return on invested capital, or ROIC. Depending on where you look, the number changes wildly. Yahoo Finance says it's 32.6%. TipRank says roughly 20.8%. But a strict Buffett-style framework, which isolates insurance operations and strips out investment income, pins it at a dismal 0.3%. Buffett considers an ROIC consistently above 15% as the best proxy for a company's moat. Actually, if you accept that strict 0.3% calculation, it essentially means Allstate has no moat at all.
And we've got a whole barrage of other red flags too. Benjamin Graham wants a current ratio above 2.0 for liquidity. Allstate is sitting at a dangerously low 0.36. That could present some real liquidity risks if we hit a severe crisis. They just barely missed Buffett's 40% gross margin threshold, coming in at 39.8%. Guru Focus estimates the stock is actually 35% overvalued right now. And perhaps the wildest thing for a $70 billion company, insiders own just 0.51%. Management has basically no skin in the game. Let's look at the other side in Section 4. The compelling green flags. The bull case fights back.
Okay, so let's pivot back to why the bull case is fighting back here, and why this stock still commands a premium price on the market today. This brilliantly illustrates why context is absolutely everything. Remember how Benjamin Graham hates a price-to-book ratio above 1.5x? Well, a PB of 2.28x is pretty easily justified when you realize the company's book value per share exploded from $82.42 to $123.38 in a single year. That is a massive 49.7% year-over-year equity expansion. When a company is growing its book value that fast, paying a premium, it becomes entirely reasonable. We also really need to emphasize the defensive power of this company. They have a fortress balance sheet with debt to equity sitting at just 22%. They have an insanely low beta of 0.16, meaning the stock is significantly less volatile than the broader market. And management is returning huge value to shareholders through a $4 billion buyback program. They've already executed $1.3 billion of it. Plus, analysts are currently holding price targets that suggest the stock is, at worst, fairly valued.
Section 5. The Guru Gauntlet. Let's put this data to the ultimate test. Let's move to the Guru Gauntlet and see how this builds as we bring our 3 legendary investing frameworks into the ring. First up is the father of value investing himself, Benjamin Graham. Now, he would absolutely love the cheap earnings yield and that 5.5x PE, but he would swiftly reject the low liquidity of the 0.36 current ratio, and he'd argue there's just no margin of safety with a 2.28x price to book. So ultimately, Graham's verdict is pretty mixed. Next up, Peter Lynch. Lynch's framework outright fails the stock, slapping it with a 39 out of 100 grade. The P/G ratio is way too high, and the revenue growth isn't quite there. Now, we do have to concede that insurance is a notoriously tricky sector for Lynch's specific calculations. It just is. But rules are rules, and under his standard framework, Allstate gets a hard fail.
Finally, Warren Buffett. And this presents a really fascinating dilemma. Buffett would definitely adore the 17.7% owner earnings yield and the elite 46% return on equity. But that incredibly confusing accounting-dependent ROIC, combined with a gross margin that just misses his 40% threshold by a tiny hair, they would make him hesitate. For the Oracle of Omaha, this is a partial pass. It would definitely require some much deeper accounting due diligence.
Bringing us to Section 6, Final Verdict, Buy or Pass. Let's weigh the ultimate moat. So let's pull all these threads together to evaluate the company's real underlying quality. The crucial point is this. Regardless of the accounting controversies and the mixed guru verdicts, Allstate's real-world operational moat is undeniably strong. Guru Focus gives it a 7 out of 10 wide moat rating. They are sitting on the immense scale of 216 million policies. They have a massive data advantage through their Arity connected car platform, tracking 50 million vehicles, and their underwriting is virtually unmatched right now. Their auto segment specifically hit an 83.3% combined ratio recently. The business itself is just incredibly well managed. But remember our pressing timeline. Today is August 8th, and we are on a 23-day countdown to August 31st. That is the ex-dividend date to lock in that 1.6% yield. After that, your next major catalyst won't be until their next earnings report on November 4th. Time really is of the essence if you're looking to make a move here.
Which brings us to the ultimate question, and one that I am turning directly over to you. You've seen the flawless underwriting metrics, and you've seen those wildly mixed guru verdicts. So what do you think? Do you believe the historically cheap 5.5x price-to-earnings ratio is worth paying the premium 2.28x price to book? Or is Allstate already fully priced, making this a classic value trap? Let me know where you stand. Thanks so much for joining me on this explainer, and I'll catch you in the next one.